about building credit, and we're going to be talking about an introduction to loans as well. So yeah, first we'll be talking about building credit. So right, yes. So today's content. So today we'll be talking about what is credit, why is credit important, what is a credit card, how is your credit score calculated, and then there is good debt versus bad debt, and also the different types of loans. All right. So first, we're going to be talking about building credit. So again, what is credit? Why does it matter? And how is credit calculated? I'll be explaining further throughout the presentation, but feel free to drop in the chats below what you think credit is. Hello. Next. Okay, not bad. That is quite accurate. The chat box, the answer. Next slide, please. Okay, so first we're going to go over what credit is again. So credit is essentially the ability to borrow money or to access goods or services with the intent and the understanding that you will have to pay this money back at a later date. So more simply, let's say owing a friend like a few bucks or some snacks. Basically, when you were young, probably in school, you would remember owing your friends some lunch money, or maybe owing them snacks because they did something for you. But in this case, we're going to be talking about how creditors such as banks or other financial institutions, they grant you or others credit based on their trust, and that you will pay back what they loaned you. So if these lenders, they decide that you are trusted, then you're said to be credit worthy. So if you're a credit worthy borrower, then it's or that you have good credit, it means that you're well trusted by creditors and that you are known to pay back your money on time, also to pay back your money in the fullest. And whether you can be trusted, it's often found through credit history and data summarized in your credit reports, which you usually get after maybe monthly or annually, depending. But yeah, it's usually after you've made purchases on your credit card. So why is credit important? Well, credit it's extremely necessary if you plan to take out any sort of loan in your future. So as lenders, they are much more likely to grant people loans to those that have good credit. So loans, they're a necessary financial vehicle, which almost everyone will need to do at some point. Everyone will have to loan at some point, or everyone will have to lend, everyone will have to borrow, and it's nothing to be afraid of. It's just part of life, part of this financial journey, and we should embrace it really. So for example, when purchasing big items like college tuition, like a car, especially a house, most people, they won't have the funds to pay for those purchases all at once. So loans play a very important role in everyone's financial futures, and it can only be utilized properly if you have good credit. So not only does having good credit affect the amount of loans that you may receive, but it also affects the parameters that are set around the loans. So for example, like your interest rates or your terms on loans. If you have good credit, you are likely to have more good terms on your loans. Like you could pay back maybe at a later time, or you could even enjoy lower interest rates. And credit, it also stretches beyond just loans. So for instance, like landlords, insurance companies, utility companies, sometimes even prospective employers, they will look at your credit info, your credit history to make their decisions. So again, with all of this taken into account, I think we can all agree that establishing and building up good credit over time is very essential to sound financial health, to better yourself financially and your well-being. So what is a credit card and how is it beneficial? So a credit card, it allows for you to borrow the bank's money to pay for things without immediately having to pay them back. And basically how credit cards work is it's different from how debit cards function, because for your debit card, the purchase, it comes directly from your bank account. Like you have a bank account already established, and basically making a purchase on a debit card, you're just technically withdrawing money from your bank account to spend on that. Whereas for your credit card, the purchases are made actually by the bank themselves, and then you rack up a bill of purchases, or otherwise known as a balance. So each billing cycle, you have to pay like a set monthly minimum, and you can also choose to pay off the debt and you create it with your purchases, or you can choose not to. But using a credit card responsibly means only making purchases that you can afford, only buying things that you have the money to pay for, and have the money in your bank account to pay back, and paying off your full balance each month, and staying out of credit card debt. Unlike a debit card, a credit card will not force you to pay back, but still it is important that if you pay back, you can actually enjoy good credit. Okay, so these are some of the benefits of credit cards. So credit cards, they play a really crucial role in receiving loans. And this is because whether you're good or bad about paying your credit card, your balance actually reflects through your credit score. Your credit score or your credit rating is all determined by how much balance you can pay within the month. So when applying for any loan at a financial institution or the bank, your credit score is one of the first things they look for, because only if you're credit worthy will they be more willing to lend you a loan. So if you have a low credit score, it'll be so much harder, so much more difficult to find a bank willing to give you a loan. They're more likely to even reject you. And the loans that you're able to catch, it'll be charged with like high interest rates that you'll have even a harder time to even pay back just for the loan itself, because you're racking up debt alone on the interest. Right, so now we're moving on to credit scores, which is another important indicator of a good or bad credit. So what is a credit score? A credit score, it's a number between 300 to 850, sometimes up to 900, which is the case for Canada. So it summarizes a consumer's credit worthiness. So which, if we remember, is how trustworthy you are, again, to pay back a loan. So credit scores, they are used by lenders to evaluate how likely you as an individual will repay the loans in a timely manner. So with credit scores, the higher the score, it's the better the borrower looks to potential lenders. So generally any score above 650 is seen as a borrower with good credit. So with these scores, how much or little you're charged for loans or lines of credit you take out, they are directly affected. So how is a credit score calculated? There are 5 key factors that contribute to one's credit score, how a credit score is determined. So here are the key factors. There's payment history, there's credit utilization ratio, there are types of credit, the length of credit history, and the hard inquiries, which we'll delve deep into in the slides, in the following slides. So the first and the most major influence on a credit score is definitely your payment history, with a 35% weight into how much your credit score is determined. So this payment history, it determines whether someone has paid their balance off on or before the payment due date over a period of time. So with payment history, the higher the total number of on-time payments you make, the higher your credit score will be. So if you're ever like wondering how to figure out the percentage of on-time payments you have made, so there is a simple formula. So you just divide the number of total on-time payments by your number of total payments, and that will be equal to your percentage paid on time. So as payment history, it's a very major part of your credit score. I can't stress this enough. It is important to take away that paying off your balances, such as credit card balances, which we'll get to in a minute, or loan balances on time, is crucial to maintain a good credit score. So next up, we have credit utilization ratio. So this has a 30% weight. And behind this big phrase, this may be new to some of you here today, it's a ratio determined by looking at the percentage of your credit limit that you've used. So basically your credit limit is the maximum amount of money that you can borrow on your credit card. So when looking at your credit utilization ratio, the lower this percentage or ratio is, the higher your credit score will be. So it's also important to note that this ratio, it depends on the percentage of your limit used. So not the dollar amount, your percentage. So for example, if your credit card, it has a credit limit of say $500 and you spend $250. So this may not seem like a very large amount of money. Okay, you have $250 left, but if you calculate it as a percentage, you have actually spent 50% of your credit limit. And this will be reflected in your credit score as poorly because you're spending half of your balance. So the third on the list is the type of credit, which holds a 10% weight. So there are actually 3 different types of credit. So they're called revolving credit, there is installment credit, and there's open credit. So revolving credit accounts. So these accounts, they allow people to borrow money whenever they want and then pay off this debt whenever they want. But also there's also a limit on how much they can borrow, which relates to the previous slide on the credit limits. This would mean that credit cards, a lot of credit cards fall under this revolving credit account. So there's the second type of credit account, which is the open credit account. And this account, it allows people to borrow money at just any point up to a certain limit, but it has to be fully paid off every month. So the difference between open credit and revolving credit is that in open credit, you have to pay off your bill. Like there is this set balance that you have to pay off each month, but also debt in revolving credit, debt can be paid off anytime you want, as you know, whenever the borrower chooses. But in open credit, bills have to be paid off every month, like including the debt. like you cannot really choose on your own. So for an example that falls under this open credit is like a cell phone plan. And finally, it's we have an installment credit account. So this type of credit account, there's a determined payment that one has to make towards the lender on a regular basis. So a great example of this is loans. Yeah, a great example of this is loans. You have to pay them back on a regular basis. So for instance, you have loan for this amount of time for maybe 6 months, but you're paying continuously for 1 month, a portion, until it fulfills to that 6-month loan that you have borrowed. So next is the length of credit history. So this has a 15% weight. And this is just determined by how long you have used your credit cards for. So the longer you have used them, then the higher your score will be, because financial institutions, they can see that you have been a responsible credit card user, a credit card holder for a long time. So this is why it is very important not to be afraid of credit cards. And it is important to get one once you turn 18 or whatever the age of majority is in your country or location. So now the length, it's not just determined by the length of time passed from receiving your first credit card, but it is rather an average of all your credit cards' length of history. So this is the final factor, which is hard inquiries. It plays an important role. It holds a 10% weight in your credit score. So every time your credit card is checked once you apply for a loan, and then when this happens, it's called a hard inquiry. So this action, it causes your credit score to drop a few points every time because they're carrying out this action. So just to evaluate your credit score, your credit report. There's also an action called soft inquiries, where the credit report is checked, but the credit score is also not impacted. So this depends on the type of credit card that you hold. So summing all of this information up, in conclusion, there are many, many facets of credit, basically accumulating debt or owing lenders money. There are credit cards which allow you to borrow money to make purchases each month. There are also credit scores that factor in these 5 credit statistics that summarize your credit worthiness. And credit is so important because it impacts your ability to receive loans and the reasonable parameters on these loans. Again, like interest rates, also the terms and conditions of these loans. And it can also affect other aspects of your life, including renting houses, receiving insurance policies, even getting hired at your dream job. So it's very important to be aware of how to use credit to your advantage and become a responsible borrower. So now let's test your knowledge. So the first question, please type in the chat box, is where is your credit history summarized? Yes, yes. The majority of you are correct. It is a credit report. Now, the second question is, what is one reason why credit is important? Yes, that is all correct. So it impacts your ability to get a loan. It can determine your interest rates, the parameters as well. And third question, what is the range that a credit score can be in? So the general range, the general range. Yes, yes. Yes, you're all correct. It's 300 to 850. And the final question is, what are the factors of calculating a credit score? So there are like 5. I think you can name at least 2 or 3. So of calculating it. Yes, payment history. Yes, how long you've had your credit card. And the types of credit utilizations ratio and types of credit. Yes, hard inquiries, you're all correct. Okay, so yep, that's about it for credit. And now I think we'll be moving on to loans. Right. So here we'll go over loans. So I'll explain what loans are, the types of loans available. We'll differentiate good debt with bad debt. It's also important to have this understanding of loans because most of us, we will take out a loan in the near future. And these loans are considered good loans because they would help you in meeting your financial goals. So let's start with good debt. So good debt is basically debt which is owed, obviously, but debt that helps you increase your wealth. Now, this seems a bit paradoxical, but like basically you're using this debt to actually invest. So this can be, for example, investing in assets, investing in the stock market, investing maybe in your own personal development, investing in your education. But be careful with the assets part though, because it may seem daunting. It may seem daunting just to take out like a loan from a bank at a low interest rate and then invest in the stock market. But the stock market is really unpredictable. It's similar to other financial markets as well. So it can sometimes lead to bad debt, even though you have intentions of good debt. So again, other examples of good debt, there are mortgages that you pay for on your home ownership or business loans that can actually help you start a career in business and entrepreneurship. So now bad debt. So bad debt is what most of us know, which is it's debt that really decreases your overall financial plan, that really strains your budget. So with bad debt, you actually end up paying high interest rates. And then it does bring like any sort of financial value. It may maybe like it's really not sure like how much financial value it brings to your financial goals. Usually it's like taking out loans and spending money on unnecessary things like fancy clothing, designer brands. And this decreases your financial plan in the long run. So an example of bad debt, like we've explained before, is credit card debt. And it's fairly easy to fall into the credit card debt because a loan is just a swipe or a tap away. So the only way to combat this is either not to use a credit card, but then again, you'll miss out on the benefits of using a credit card, or to just pay for what you make. So now I actually have a question for you. Some of you, or maybe a lot of us here today, will be familiar with student loans. Student loans are a major crisis in America and Canada. They're racking up a lot of student loan debt because students want to go to school, but they also need loans to help fund their studies. So in the chat box, I want to hear, like, do you think student loans is a part of good debt or bad debt? So please answer in the chat box. Okay, good debt. One good debt, good debt. Okay, so a lot of you, I think a majority of you agree with that student loans are a form of good debt because they're helping to fund on your studies. It can be both also, depending on how much money you have or will make. That's a very good answer, right? It could also be bad debt if you can't pay it off, right? Yes, if it strains your financial plan, then it could be considered bad debt. So let's move on. Yeah. So now we're going to be finding the middle point. So the middle point between good and bad debt, basically a compromise. So finding the middle point is extremely important. Now, what exactly is the middle point is having the middle point means to make sure that your good debt is not converted into bad debt. And obviously, like any sort of bad debt is still bad debt. So the debt that you do not want. So as we remember, with good debt, you get low interest rates. However, if too much money is borrowed, then you could potentially get higher interest rates. And this will negatively affect your credit score and your financial plan. So it is also important to consider the use of loans, as one can be tempted to unwisely use their good debt. So it is also important to factor in that if your investment goes down, maybe due to an economic decline or a recession, then too much of good debt, which soon become bad debt, which you will need to pay. So it's important to make sure that you find the balance between good debt and bad debt so that your good debt does not convert to bad debt. So term loans. So term loans are basically, I think the name suggests itself, it's loans over a term, so like over a period of time. So whenever you take out a loan, you pay it over installments. So you pay it over monthly, semi-annually, quarterly. It depends on what loan you've taken out. And then installment dates, it could vary depending on who you take the loan from. And remember that like we have to pay an interest rate on these loans, and it's usually compounded every year. So it's a compound interest rate. It means that the money is almost like the interest is almost multiplied. But do not worry about it because this is very common of all loans. So revolving loans are compared to term loans, they're not very like common per se, but so in revolving loans, the borrower, they give any amount of money, a specific or set amount of money, which can be withdrawn, and then they will use it on a need basis for a specific amount of time. So unlike the term loans, so you do not actually have to use the whole amount. So basically, if you have a loan of maybe $10,000 or some, just for example, then you don't have to use the entire $10,000 in your loan. You may use like maybe $5,000 for a specific period of time, and you can use this money from loan whenever you like, and then pay interest only on the money that you have used, only from the $10,000, only from the $5,000, only on the $5,000. So essentially, this is a line of credit. As we stated, credit, a revolving loan. So in the chat box, in your opinion, in all of you guys' opinion, is revolving loans better than term loans? What do you think? Okay, so some of you say yes, some of you say it really depends if it's a revolving loan, if you're more responsible with your time, then it would be beneficial for you. So these are good answers. So let's move on to. So now here, we'll be talking about the types of loans. Yeah. So this is the first type of loan, which is a mortgage. So a mortgage is basically a loan you take out to pay for your house and to continue your ownership of the house. So this helps you like finance your whole house. You pay the price that is borrowed along with an interest rate. So the price borrowed is a fixed cost, but the interest rate would be variable. And if you do not pay your loan on time, then the lender has the right to actually take possession of your property. So it's important that you pay your mortgages on time, and your house, it actually acts as a security for your loan. And if you've seen mortgages, they take over like quite often a long period of time, maybe 30 years, 20 years or something like that, to finance your entire house so that you have actually paid for the value of the house that the lender has actually appraised on your house. So the second type is secured and unsecured loans. So firstly, secured loans, they're backed by a collateral. So any asset that you own, basically any security for your loan repayment, it's easily it can be easily approved, and secured loans usually have a lower interest rate and they can guarantee you higher loan amounts. So on the other hand, so unsecured loans, so they're not backed by a collateral. So it's very difficult to find approval. It also has a higher interest rate, and typically you would only have a lower loan amount that you could borrow through an unsecured loan. So this is the third type, which is home equity line of credit. So in this case, borrowers, they use equity in home as a collateral. So again, as the security for the repayment of your loan. And the loan is actually determined by the value of the property. The appraisals come from the lender side, and it's popular choice for making renovations to the house. So unlike mortgages, so the loan is actually determined by the value of the property rather than any set amount that you've agreed upon with the lender. So this is a really popular choice with renovations. So the fourth type of loan, I think this is pretty common. So this is a personal loan, basically money that is borrowed to cover personal expenses from financial institutions, or maybe just from your friends or family. So this money borrowed, it's usually used to maybe cover home expenses, such as electricity bills, water, stuff like that. And it usually lasts for like 12 months, so like a year to 84 months. So it can last for about 7 years. So in this time, you actually pay your interest and your loan value. So this is fairly simple. So small business loans. So these are loans, they're provided to entrepreneurs to kickstart their business. And usually entrepreneurs, they can either sell a piece of their business, or they can actually take out the loan to help cover the cost. So either small entrepreneurs, if they're lucky, they could go and woo investors to help invest in their small business and maybe even give them some ownership or share in the business, or they could take out the loan to just help cover the cost. And if the business is successful in the future, then this initial small business loan can be really helpful. But this is also a risk to take on business as an entrepreneur, but this is part of an entrepreneur's function as a job, that they are risk takers. So the last one that the last one is student loans. So loans that are provided to students to fund their education, their tuition fees, sometimes living standards. It could be private, it could be provincial, or it could be federal loans. It really depends on the country. And usually student loans, they have lower interest rates and they have higher time frames, with sometimes with like a grace period and loan forgiveness. So loan forgiveness is like because maybe you have no chance or very slim chance of paying back your actual student loan debt, that they might actually forgive that debt for you. Or there's also like a grace period, basically a time where maybe 6 months, 1 year, that you don't pay back your loans at all. It's just after you've maybe graduated, there's this grace period to help you build up financially first, so that you can pay back your loans after the period. And this is an essential loan for students to fund their education. So low interest rates. So countries have a lot of different interest rates. They are very dependent on inflation and economic growth. So when there is an economic decline, so interest rates, they are low to make the borrowing cost cheaper. So when interest rates are low, the money supply will increase. So basically this money supply, this increase in money supply helps stimulate the economy. It helps satisfy the money demand in the economy, to help spend for stuff, to help pay for stuff, to encourage businesses or maybe students, everyone to just lend more, to keep spending and contribute to the economy. This is during economic decline. And during COVID, usually interest rates are low, they're cheaper. And so in Canada, the Bank of Canada, it determines Canada's interest rates. So this is an example of a central bank. I think in every other country, a central bank sets their interest rates. And in Canada and US, they have a lot of like lower interest rates. And a lot of developing countries like Georgia, Turkey, even Myanmar, Burma, where I'm here, we have, I think about last time I checked, there was a 7% interest rate. And that was actually reduced from 10% during COVID. So, right. And in developed countries, they have a lot of lower interest rates. Right. So that's in conclusion. Loans, it can be really helpful to like meet your overall financial goals. And still, it's important that you differentiate good debt and bad debt, because it's extremely important, especially when loans become very helpful once you reach a certain age. And either way, they're still debt by the end of the day. And you should always try to find the middle point, the compromise between good and bad debt. There are also two different types of loans. So there's term loans and there's revolving loans. In term loans, you take out the money in a lump sum and you pay installments with interest on it. In revolving loans, they're basically lines of credit where you can actually decide what you want to take the money out, and you only pay the interest on the money you take out over the above the like overall money that you have. And there are also 6 types of loans which can be used depending on your goals and situation. I think student loans will be most applicable to a lot of us today for future use. And finally, your interest rates, they vary depending on your location and depending on whether your economy is really developed or developing. So some countries like Turkey or where I'm from, we have really high interest rates. And someone actually asked a good question here. And why is that? Is because in developing countries, we are trying to encourage spending like a lot in our economy. We're trying to boost our economic growth by a lot, and we're trying to, we're trying to boost the economy in general, whereas in developed countries, the economy is already quite in a stable growth compared to developing countries. So let's test our knowledge again in the chat box. The first question, what are term loans? Right, okay. Yes, yes, that is correct. So you pay in installments, loans have to be paid at a set schedule over a period of time. And then like you actually pay back your loan on the entire lump sum that you have, intended to borrow. So the second question, so what is a good example of a revolving loan? So this is based on the 6 types of loans that we have just learned. So what do you think is a revolving loan? Right, credit cards, home equity lines of credit. Yes, that is, those are correct. And third question, what is the most common loan for housing? Mortgage, right, that is great. And the last question, I think, what is the best loan for entrepreneurs? Is it personal or small business? Small business loans, right? So that is it, I believe, right? So thank you all for listening, and thank you all for really participating in this camp and listening to my presentation. So our presentation. So thank you, everyone. Any questions? I think we'll be answering the chat box.
Okay, if not, I'm going to give everyone a very short break before we can move into our guest speaker session of the day. So I'm going to stop presenting my screen and I'm going to turn on some music, and we can get started with our guest speaker very shortly. Okay, so now I'm excited to invite our first guest speaker for the day. Her name is Orina Chang, and she's an alternate investment director, senior portfolio manager, and international client advisor. She has over 25 years of experience in institutional and retail investments, and she's been with Morgan Stanley since 2016. So feel free to get started.
Sure. Claudia, are you on? You need to unmute yourself. Am I able to share screen? I don't hear her.
I gave it to Claudia, like the host, but I can also do that for you so you can share your screen.
Okay, because I can't. Claudia,
oh,
she's
sorry.
here.
Yes, I'm on.
Okay. All right.
Yeah, and I'll be able to share a screen. Or
actually,
if you want to do it.
Hold on one second. You can do it, but before you do, I just want to ask everyone in the group, how many people are actually investing right now? How many people that has either a real investment account or a paper portfolio that you set up on Yahoo or any kind of the websites? Not yet. So I'm guessing someone wants to look into it further, hoping to create one, would like to. Oh, there's a person that does. Someone created one. Someone wants to learn more about it. Okay, perfect. Yeah, so I want to talk about the fundamentals of personal investing. So personal investing is a little bit different from investing for corporations, and we'll talk about it. And for those who have already, someone has an investment account, someone set up a paper portfolio, and there are people who wanted to learn more about it and intend to actually invest. Can you give me an idea what you're investing in? Are you investing in stocks, in bonds? What are you investing in? Or what are you looking into investing in? In Bitcoins, what are they? Stocks, okay. So I got one answer. Someone is investing in stocks, in crypto. I'm not surprised. Stocks and crypto. Stocks, okay. This is awesome. Someone wants to know more about NFT, okay? Oh, NFT and crypto. This is definitely the new generation. Stocks and NFT, okay. Forex as well. Okay, this is great. I love this. Okay. All right, so I'm going to talk about the fundamentals of personal investing today. And we're going to touch on in what situations should we invest in stocks or cryptos, and how much do we invest in stocks? How much do we invest in cryptos? How should we allocate? And all right, so one more question. Actually, let's go to my website. I'm going to when do you guys know what is an asset class? That's my question. Does anyone know what asset class stands for? No. Okay, perfect. No. Okay, great. Oh, great. This is good. All right. Okay. So when you think about personal investments, you're thinking about, returns that comes from stocks, bonds, maybe cryptos, and et cetera, right? So we're going to talk about different sources of returns, and then we'll focus on just different asset classes. Okay, so Claudia, can you go to my website?
Yes.
All right.
Can you see it?
Yeah, can you go to the tab where it says, I think 3 steps. Can you go down a little more? I can't see. All right, so let's go to working with you. Okay. So for personal investments, I can see from the chat box, everyone is either investing already or thinking about investing. And when you're investing, obviously you want to make returns. And so when you're thinking about making returns, your initial idea is you're return comes from either whatever instruments, whatever financial instruments that you invest in, which would be either the stocks or the cryptocurrencies or the digital art, etc. That's what you're thinking. But let me tell you, someone did a study. It's actually someone at Morgan Stanley. I think it's one of the Morgan Stanley studies. Most returns, over 90% of your personal investment returns actually comes from asset class you choose. And what is an asset class? An asset class is either a stock is an asset class, crypto is an asset class, bonds is an asset class, a home, a real estate property is an asset class, collecting coins is an asset class. Those are called real assets. Oil, any kind of like a diamond is an asset class. So whatever that particular thing that you choose, that is an asset class. And most of the returns actually come from what asset class you choose, not the actual investment selections itself. So the actual investment selections would be if you choose to invest in stocks, and within the stocks universe, you choose to invest in, let's say, Amazon, Apple, Tesla. Tesla is very popular these days, or any kind of stocks, right? Whatever stocks that you select, that's the investment selection. But the fact that you choose stock itself as an asset class to invest in, that is where your majority of your return would come from, is coming from asset class. Is this clear to everyone? Or what is an asset class? Does anyone have any question before I move on? No questions, clear. Okay, perfect. All right, so because most of your returns will come from the asset class that you choose, that should be the most important thing that you decide on. What are you? Can you have multiple asset classes? Yes, of course. And actually, in fact, most people have multiple asset classes. Most people invest in, for most of us, the biggest investment that we have is our home. So that's a real asset. That's our property. And then, outside of our home, we might also invest in fixed income. So some bonds, and for younger generation, you would invest in crypto, in stocks, in your digital art. All these are different asset classes. So most people actually have multiple asset classes. And it's very important to know, or to decide, one of the important decisions is, where does money fit into an asset class? So a cash in itself is an asset class. So it's a category on its own. And for a very important decision is, how much do you leave in cash? How much do you put into your home? How much do you use to buy stocks? How much do you put into fixed income? Because all those percentages actually determines most of your return source, where your return comes from. And that's one of the most important decisions. Okay. So keep shooting in any questions that you have as I talk along, because these are the fundamental, sort of the fundamental concepts of personal investing. Now, the second investment source that outside of asset class is the tax savings that we have. Okay, so the more you can keep without paying to Uncle Sam, the more it hits your bank account. So the second very large investment return source that contributes to your wealth is tax savings. So that's why the second step is called choosing appropriate legal structure to invest. So can anyone think of any kind of tax efficient investment? Maybe this question is too early in your life, but if anyone has an answer, you can shoot in the chat box. Otherwise, I'll give you an answer. Okay, your retirement account, right? Your IRA. Are you familiar with a retirement account, an IRA? No. Okay. Okay. So most people don't know. All right. Putting your money into foundations and charity. Okay. Yes. No. Okay. First time hearing it. Okay. Perfect. Putting your money into foundations and charity is money that you would give away. You can save on taxes. Can we elaborate? Yes, we can elaborate on taxes. You can save on taxes if you donate money to charity. So you save some taxes that you would pay to the government, but net, you're still giving away more money. So you're doing some good deeds, but you're not making yourself richer. Can we elaborate on, all right, okay, is not investment. Yes, thank you. Okay, so we all know that every time when you make some money, you have to pay a portion of your income to the government. That's called taxes. So for taxes can range from 25% to almost 50%. So if you make $100, $25 to $50 would actually be given to the government, and the rest is yours, right? So that's the taxes that you have to pay. The more that you can save on taxes, let's say instead of paying $50 to the government, if you're able to only pay $25, then you have $25 more in your pocket that you can invest, right? So that's the savings on taxes. And that is very, very big for personal investment. And that's why for most of us, we should take advantage of that. The one thing that everyone can take advantage of is a retirement account. And what it is that when you start to come out and work, when you have a job, you can start putting a portion of your money into a tax deferred account for investment. So there is actually a cap of how much you can put in. The government gives you an upper limit of how much you can put in. For a lot of people, it's $6,000, depending on different type of structure. You can put up to, $250,000 of tax deferral money. So how it works is that the actual investment return that you make in this particular account, you do not have to pay taxes until you retire. You cannot take it out to spend it. You have to keep it in an account, but you can keep on making investment returns without having to pay taxes until you retire. I hear that you can get a life insurance and take it out while you're still alive. And yes, that is called annuity, not life insurance. So life insurance would be what you leave after you die to someone else. But you could have an annuity with a life insurance part attached to it. And that's also tax deferred. Yes, very good. So that's the second source of your investment return. So we're not going to talk too much on taxes, but just remember that tax savings can be very, very huge that would add to your wealth. So when we invest, we try to be tax efficient. We try to take advantage of all the tax deferral accounts that we can. Part of it is annuity. The issue with annuity is that the fees are very high. So they range from anywhere between 2% to 4%. And if you're paying that much a year to annuity, sometimes it's not worth the savings. So that's another topic we can talk on. But we just need to know the first return source is your asset class. That's picking how much you want to invest in bonds, in stocks, in your home, in coins, in any kind of asset classes. The second one is to have as much tax savings as possible. And the number 3 source of return is the actual selections that you're thinking of. Which stock do I pick? Which, Bitcoin do I pick? Which coin do I pick? Which home do I buy? So that's the actual selection. Now, the actual selection, is hard to do on the personal level because that's not your full-time job. It takes a lot of years of trainings to do. So what you can be mindful of is to pay the amount of fees when you're selecting these investments. So for today's talk, we're going to focus on asset classes, because asset class is actually where your biggest return source is going to come from. So do we have any questions up till here? If not, I'll move on to asset classes. Real estate can be a good asset class, right? Well, real estate is a good asset class. It's buying and selling real estate. Okay, buying and selling real estate is the transaction cost is very high, right? If you're not a real estate agent, you pay 6% to the real estate agents. You have to pay taxes. You have to pay you have to pay advertisement, etc. So at the end, you probably pay 8%, give or take, as a cost to buy and sell. And, yeah, so that you just have to factor that in. But and real estate as an asset class, based on history, without naming a particular area, on average, it appreciates 3% each year. So every year it appreciates 3%. Does anyone know how much the US stocks appreciate every year in history? Every year, US stocks? Does anyone have an answer? Okay, I'll give you the answer. US stocks, when we measure the US stocks in S&P 500, okay, which means the largest 500 public companies, 500 largest stocks in the US, appreciates about 10.5% a year, 10.5% a year. And the real estate market appreciates about 3% a year. Okay, so it's also a lot easier to buy and sell US stocks. And it's also a lot cheaper to buy and sell US stocks. So when you're investing, you will take all these into consideration. Obviously, your home is not just an investment, it's a place where you live in. So it has a different value than just monetary value, right? So, so that's something you would take into consideration. Now, let's talk about asset classes. How much do you put into stocks or bonds, or your home, etc.? Claudia, can you move move this up a little so I can see the tab? Yeah. Okay. So can you click on your customized portfolio? Yes. Okay. So the key concept I want to give to everyone here is that the higher the asset class return, the higher the risk, and it will take longer time when you invest. So I'm going to give you a very quick concept. I assume that every one of you has like a checking account, right? Do you all have a checking account? Yes. Yes, everyone has a checking account. Perfect. And you will put cash in your checking account, and that's to fund your expenses, right? A savings account. Okay, you have a savings account, you have a checking account. The checking account is to pay for, the food that you want to buy, maybe the dress that you want to get when you go to the mall. When you go out with your friends, you're paying for maybe a bagel, a cup of coffee, etc. So that's your checking account. It's money that it's readily to spend, right? So you would not actually invest in those. You would not invest those money, the checking account money. So because that money is going to be in your checking account for a very short duration of time. So if you put that money into, let's say, Tesla, and you need to spend it tomorrow, but Tesla goes down tomorrow, then, let's say by 10%, your $100 would become $90. And, that might not be a good thing because now you don't have enough to do what you want to do. So checking account, the investment, if you were to invest that dollar, the investment horizon is too short to actually invest in something like a stock. It will be too risky. So the key concept is to remember that the higher the risk, the longer the time you need in the investment account for that return to realize, right? If it's too short, then you would run into a situation where you need to sell your money and you need to sell your investment and you're losing money. So Claudia, can you go to the third? Go to just change the, go to the third. Oh, actually, no, not this one. Can you go up? No, can you go up? Yeah. Go to redefining risk and go to the third slide. Okay, so here's the third slide. Okay, so this is a very exaggerated, extreme two examples. The top line, the white line, is someone's investment in the S&P 500, and the yellow line is someone's investment in a very safe government bond. So the government bond is a fixed income, it's like a loan that the government is borrowing money from you. If you put money into this bond, you're lending money to the government, to the US government. And US government is really, there's no risk. They will always pay you back. As we're learning from Toll, the different types of loans. This is the safest bond that you can actually purchase, right? And you can see that if you invest in the stock market, this is a 10-year chart, right? So for 10 years, if you put your money into the stock market, which is the white line, your money would go from 1292 to 4356 at the end. So you will go from 1,292 to 4,356. That's how much your money would become in 10 years. But instead, if you choose your asset class as your fixed income, the very not risky bonds, right, to lend your money to the US government, your money would go from $621 to $659, right? So not as good as for return. But if you don't have 10 years, let's say, so let's say if you have 10 years and you pick bonds, you're giving up a lot on your returns. But let's say if you don't have that much time, you don't have 10 years, and let's say you only have 1 year, right? Where it says entry, that's where you put your money in, and you have to take your money out on the red line where it says bad exit right there. Yes. So then, if you put your money into the S&P 500, which is the stocks, the largest 500 stocks in the US market, then you would have lost money. Whereas if you put it in the lower risk asset class, the bonds, you would be okay, right? You can see that would be okay. So it's very important when you're thinking about how much money you're going to, or what money you're going to invest in stocks or in bonds or in properties or in cryptos or in digital art, in any asset classes. Think about how risky it is. The riskier it is, the higher, the longer investment duration you would need. Do you guys have any questions up till this point? Is this clear? Okay, great. So it depends on how long and how much you want to invest. Perfect, yes. It depends on how long you have and how much you can invest, yes. So the longer the amount of time you have, the higher the risk you can take. So if you want to choose to invest in stocks, then you need more than a year, right? As you can see. Now, Claudia, can we go to the asset class map? Well, what would be how much time do I have from here?
We have between 10 to 20 minutes.
10 to 20 minutes. Okay, then Claudia, can you go back to my website? And can you go to your customized portfolio and then go to the third chart? So someone was asking, can you do multiple asset classes? And I said, definitely. So, and then, you know, we also talked about this concept of how much time, the longer the time horizon is, the riskier the asset class you can pick and the higher potential return you would have, right? If your investment time horizon is very long and you pick something that is very stable, like a fixed income, like a loan, then you're giving up potential return. You're not going to make as much money. But if you are having a short amount of time, then you should stick to something that is not so risky, right? So let me give you this study that Morgan Stanley did on the time horizon and how it impacts risk and reward on different asset classes. Claudia, can you make this a little bit bigger? It's a little hard to see. Yeah. So you can see there are 3 different columns. One is a 1-year return. The second one is a 5-year return. And the third column is the 10-year return. And so on the very top, that's a 100% portfolio in stocks. So you only invest your money in stocks. At the very bottom, you only invest your money in bonds without stocks. And it tells you based on the past 47 years of market returns, how it looks like if you put all your money in stocks or all your money in bonds, and the different mix of your asset allocation in stocks and in bonds, how it looks in 1-year term, in 5-year term, and in 10-year term. So if you put your money in your investment for only 1 year or for 5 years or for 10 years, right? So you can see that if you only put your money in for 1 year, in stocks, 100% stocks, right? The worst return that you can get if the market doesn't do well, you will lose 45% of your money. If the market does really, really well, you're going to make 64%, 65%. On average, you know, a 1-year return should be about 13%, right? If you go down to a no stocks, 100% bonds portfolio, in 1 year, you would lose 2.2% if the bonds don't do well. If it's like the worst market for bonds, if you can make 32% if it's the best market condition for bonds. On average, you would actually make 7%. So you will make 6% less than from all 100 bonds portfolio on average. I mean, 100% stock portfolio on average. But you can see that bonds are a lot less risky. You will not lose as much money if you only have a 1-year horizon. The most you will lose is -2%. But if you go into 100% stock and you only have a 1-year time horizon, you are going to lose 45%. In a really bad situation, right? If you put everything in stocks. But if you have 5 years, let's say if you put all your money in stocks for 5 years, okay? Then now the worst you can do is not -45% anymore, is -6.4. So the longer time frame you have, the more risk you can take, as you can see, right? If you have now 10 years, in the all stock portfolio, the most you can lose is now -3.7%, right? On the other hand, the most you can make now went from 64.7% in a 1-year time frame to 30% in a 5-year time frame to 19%, 19.7% in a 10-year time frame. So right here, you can see how, you know, the longer the investment time frame is, the higher the probability you have to make money in a riskier situation, asset class. Your average would be very similar in all 3 cases. So does anyone have any questions up till here? I don't think we have any questions, right? Okay. So in this chart, what you can see is this is a really good chart to study when you start to invest. When you're thinking about how much you want to put into bonds and to put into stocks, you want to think about how long is your investment time frame, right? The longer you have, the riskier you can go, and the more stocks you can have, you can actually invest in. So it lays out the different mix: 100% stocks, 90% stocks, 10% bonds, and etc., all the way down to no stocks and the 100% bonds. And in the 1 year, 5 year, and 10-year situation, kind of what's that range of return you will see, right? Is it what's the worst you can do? What's the best you can do based on the past 47 years of historical returns? Less years, more risk, but more chance of making money. Yes. So you have to think about, are you okay losing that much money? You have more chance to make money, but you also have more chance of losing a lot of money. And it just depends on, what are you going to do? Do you have a plan number 2 if you lose that much of money? Are you okay with it? So this is a very good chart for you to kind of study. Yeah, any questions or comments? Okay, if not, Claudia, can you share the website address so that anyone who is interested can come to this website and you can kind of browse around the different charts if you're interested in looking further. Can you type it into the chat room for everyone?
Can you guys see?
Yeah, I can see it.
Okay, perfect. All right, so we're gonna go over to an asset class map, and I will touch very briefly. I think we're kind of running out of time on different asset classes and how risky they are. So this is the asset class map, and on the very top is the less risky, the most stable. Which investment would you suggest for someone who is just starting out? So again, it depends on how long you can put away that investment. If that investment you can put away for 10 years, then there's really no need to invest in anything that is low risk. You can go for a high risk like a S&P 500, like US stocks, but don't pick individual stocks because you don't know if they're good or bad because you're not trained in that. So just buy a basket of stocks, right? What is called an ETF. I don't know if you guys have heard what an ETF is, but basically that is a basket of stocks. Okay, no. Okay, an ETF is a basket of stocks. That's so let's say an ETF of S&P 500. That means is 500 different stocks in that ETF. So let's say you only have $1,000. It would be hard for you to go and buy 500 stocks, right? But because the whole point is you don't want to pick one stock, and in case you lose money in that one company, it's hard to make it back because you don't know which one is good. So a good approach is to buy all 5 of the largest companies. But if you only have 1,000 that you want to invest, it's hard to go buy 500 companies. So you would buy one single ETF that has all 500 companies in there. So that's an ETF, and it's relatively inexpensive to buy them. There's not a lot of cost or trading fees. So you would save a lot of money on cost. So that's an ETF. So what investment you would suggest would depend on how long your investment horizon is. Another place you can check is I put out a couple of videos on my LinkedIn. I talked about these concepts. We talked about pros and cons and what to look out for, but where I'm sorry. What was the question? Keisha? We talked about pros and cons and what you look out for, but where do the investments actually take place? Oh, you would open an account. So if you open an account with a place like Robinhood or E-Trade, TD Ameritrade, that's okay. That's where you would actually buy and sell these investments. That's where you can buy stocks, you can buy ETFs, you can buy bonds. So you would actually start an account in one of these brokerage houses. Does that make any sense, everyone? You can always email me if you have further questions. How do you determine which houses are trustworthy? So these are all very large companies. They're all public companies, so they're very trustworthy. You just need to find some the cheapest place. The more fees you can save, the more it goes into your investment return, the less you pay. Any more questions? Okay, so this asset class map, if you want to take a screenshot, you could do that, or someone can, maybe Armida can email it to everyone. She has a copy. So it lays out different asset classes from the least risky to the most risky at the bottom. And within each asset class, from left, so from my perspective, from left to right, that's from the least risky to the most risky. So you can, these are different asset classes. So cash obviously has no risk, but it's not going to make you any money. And the $100 today is worth less than $100, in 10 years, because you're going to be able to buy less things. So if you leave your money in cash and not invest it, you're not taking any risk, but you're actually losing money because you won't be able to buy, as the purchasing power would actually erode over time. So cash would be your least risky asset class. Someone asked that question before, is cash an asset class? The answer is yes, and it has no risk, but it also won't make you any money, and it will be less valuable in the future. There are different prices depending on where you buy your investments. Yes, the trading cost is different depending on where you open your account. The places where there are basically no services would charge you the least amount of money for trading. And then, so going back to the asset class map, so then on the very left-hand side, you have your cash alternatives, what's called cash alternatives. So they're basically like cash. They're slightly more risky than cash. It pays you a little bit of interest. So like your CDs, your money market, your US T-bill, which was the last example we gave. You lend the money to the US government and the government pays you a little bit of interest, right? So these are like the least risky. And then you have your cash deposits and you have your USD. So that's US dollar cash deposit. So you can put your money in a different foreign currency as a cash deposits, but that would actually be risky if you go into a bad country. The second part is fixed income. That's your bonds, right? Your bonds would be, you can lend money to the US government or to a US company, or you can lend money to a non-US company. You can lend money to some kind of city government. All these, they would pay you interest. And the higher the risk, the more the interest you will collect. Is there a resource sheet about the houses and website we can use? Oh, I actually don't have that. I work for Morgan Stanley, which is a full service firm. So we're pretty expensive. You would just type in investment account. Where can I open an investment account? And all these things would actually pop up. So Robinhood is very popular. TD Ameritrade is popular. E-Trade is popular. There's Charles Schwab. There's a lot of different companies that you can look into. There's Fidelity. There's a lot. And then after fixed income, that's your bonds. The next asset class is your equities. So the safest, the least risky equities, that's your stocks, right? Would be your US stocks, followed by like European, Japanese, Korean stocks. Those are developed markets. And then the highest risk stocks would be emerging market stocks, like your Chinese stocks, Russian stocks, Brazil stocks, or anything that is classified as emerging markets. And then the last asset class is your alternatives, which are these commodities, real estate, private equity, precious market, metals. You don't have to really get into that. Hedge funds, we don't have enough time. Each class, takes at least a class to kind of talk about them. But I think what is good to kind of take away from this talk is your cash, your bonds, and your equities. Those are your kind of the most common asset classes that you can invest into. And from the left to the right are the amount of risk that you are taking. The left being the least risky and the right being the most risky. In the stock market, these different stocks, you have large cap, mid cap, and small cap. So that's large companies, mid-sized companies, and small-sized companies based on how much the total market cap is. So I think we'll stop there. I don't know if we have any questions. That's all the time we have. Does anyone have any questions? All clear? Okay, good.
I have a question though. It's a very short one. Do you mind if I ask?
Of course.
Right. So a concern that I have is when we, especially in the context of stocks, is an investment portfolio better if it is diversified, spread across different fields, or if it is collected in around the same field? For instance, somebody decides to have stocks in one stock in like an animation company, then they have like in agriculture, and then they have it in, I don't know, bottle making companies. So they're all over the place. They've bought stocks from companies that are all over the place. Whereas somebody who focuses on a narrow area, let's say hair care, so they buy stock from a shampoo company, they buy stocks from like hair product company, they buy stocks from hair dryer company. So you have all of them in the field of hair. So in that kind of a case, would it be better to diversify like a range of different places or collect in a narrow area?
So that's a very good question. That goes back to the basic fundamentals of investing, risk and return. The more diversified you are, the less risk you have, right? So if you have investment in 500 largest company in the US, that's diversified. So that's less risky. If you have what you were talking about, we call it a sector. So you have stocks only in the electronic vehicle sector, like a Tesla and maybe a Lee, a NIO, whatever. That's much higher risk. Therefore, if you're right, you can actually make a lot more money than putting in diversified portfolio, right? If you're right. But if you're wrong, then you're going to lose a lot more money than if you put it in the 500 companies, right? So if you start to want to get more concentrated, we call it a concentration into a certain stocks, like what we were saying about just picking stocks, and you're not diversified enough, then you have to rely on your knowledge of these companies to make sure that you're right. But if you don't, and you invest in the 500 largest company in the US public market, then you don't really have to be right, because you know that US economy is very healthy and the stock market goes up over time. So then you don't need to study these companies. You're basically picking an asset class of stocks, and then you just have to think about how much time frame you have, as that chart was telling you. Very good question.
Thank you.
You're welcome. Any questions? I think that's it. Well, it's very nice talking to everyone. You're welcome. Feel free to connect with me on LinkedIn. I publish videos once every couple of weeks, sometimes a month. So you can check out these videos and you can continue to learn these concepts. And you can also email me if you have questions.
Yeah, thank you so much for that presentation.
Can I have your email? Yes. Claudia, it's orina.chang@morganstanley.com.
And I'll be able to share all of the links and emails and resources after the event.
Okay, sure. All right. Thanks, everyone.
Thank you so much.
And have a nice holiday. You guys are all, I'm inspired by you and impressed. I can't believe you're logging on to learn about financial concept during the holidays. Bye now.
Goodbye.
Bye. Okay, guys, so right now I'm going to be giving everyone a 5-minute break before we're joined by our second guest speaker for the day. So I'm going to be turning on some music and everyone can take a break before we go into the next portion of our event. Okay, everyone. So today we are now going to begin with our second guest speaker, who is Bianca Carbo, and she is from the organization EntrepreYOUership, and she's going to be delivering a presentation about entrepreneurship as well as funding opportunities that the organization is offering at the moment. So Bianca, you can start whenever you're ready. So I'm going to continue playing music until Bianca gets started.
Hi, can everyone hear me? Yeah, I am having technical issues.
We can hear you, but we can't see the screen.
Oh, okay. 1 second. Let me try to sort that out. Huh.
You want to maybe like leave the meeting and then come back?
Yeah, I'll rejoin. Okay, so can you guys see my screen now?
Yeah, we can see it now.
Okay, great. Okay, so I'll just get started. So, oh god. Okay, so just a little bit about me before I start. So I'm an ambassador for EntrepreYOUership. Some of my passions include business, computer science, and human rights and mental health advocacy. I'm from Guyana, and a fun fact about me is I'm a Capricorn. That's the fun fact. If you guys would like, you can answer these questions in the chat too. Oh, okay. I'm just gonna get started. So what is EntrepreYOUership? We are an international youth-led organization that equips youth with an entrepreneurial mindset to make social impact. Our tagline is, "You can do it too." We want youth to see themselves as capable of launching ventures even when they are young. We offer startup funding for youth ages 10 to 21, free consulting services to help you create business plans, ongoing mentorship, and a supportive international community. Our mission is to help youth launch businesses and support the next generation of founders. Since 2019, participants have accessed free consulting and mentor services valued at over $50,000. EntrepreYOUership support extends beyond our events by providing youth with access to free consulting services, funding opportunities, and an extensive network of mentors. So this is just a little intro to entrepreneurship. So entrepreneurship is the process of designing, launching, and running a new business or venture. It is the act of creating something where there once was nothing. It means looking around your community and asking yourself what solutions you can offer for problems you see. Entrepreneurs develop products, services, or social movements. Being an entrepreneur does not require venture capital or an MBA. So developing an entrepreneurial mindset will help you be successful in your future with any work you pursue. Entrepreneurs are go-getters. We claim the power to take ownership of a project. We build teams to get things done. Entrepreneurs view problems as opportunities. We look for new and creative solutions to meet needs around us. Entrepreneurs are flexible thinkers. We are willing to change plans to overcome present and future challenges. For example, adapting and responding to pandemic needs. So 3 things entrepreneurs need to get started. So number 1 is passion. What things do you care about? How can you monetize your gifts and talents? Number 2 is solutions. People don't buy products, they buy solutions. Look around your community, problems that you can solve. You don't have to reinvent the wheel, adapt a current product that already exists, offer a service in a different or more affordable way. And lastly, dedication. To turn your idea into a business, you need to dedicate time to the process. Our community is here to help you generate ideas and help your ideas come to life. So what are you waiting for? Our best advice is get started today. Entrepreneurship looks different for everyone. Do something that matters to you. Don't overthink the process, just start. Our world is waiting for you and your ideas. We are here to support you in every step of the way. So there are many funding and opportunities to stay connected, so please join us. So you can participate in our global startup funding competition. We want to provide you with the materials needed to launch your own business. Find the application on our Instagram and website, www.entrepreneurship.org. I'm going to send all the links in the chat after this. So the spring application is due on March 15th. All you have to do is answer these 3 short questions and make a 1-minute video pitch. You can also enter our essay contest, win gift cards, build your resume, get international exposure, and media features. That's due on January 31st, 2022. The only requirements are you have to be between 10 and 25, and you have to have an essay of between 250 to 750 words. So we are here to help. You can also join our Discord, access free consulting, peer feedback on business plans, and an international community. So thank you. If you have any inquiries, please email them to this email. Okay, so I'm going to put all the links in the chat if any of you are interested. Okay. Thank you. That's all that for me.
Okay, thank you. So I will share these resources after the event, and for people who are interested in getting funding for any project that they're starting, this is a great resource to go to. And with that said, we're going to be doing our last activity for the day, which is a Kahoot, and make sure you stay around until the end where we have our feedback forms, and we need people to fill that out to know what we can improve for the next day, as well as when we want to give out people certificates at the end of this event. That is where we will be able to access the contact information. So I'm going to start the Kahoot shortly, and we are going to move into our last activity for the day. So make sure to go to this page with the pin that is shown on the screen, and then we can get started. Okay, so we can get started and more people can join as we go along if they would like. Yeah, so that is correct. Taking out loans for student loans is a way of using debt responsibly because you will be able to receive an education that will help you qualify for better jobs down the line, whereas the other ones, such as your bonds or using all of the credit offers in the mail or taking payday loans, are actually examples of bad debt because you will be losing money in the long run without gaining much for yourself. Yeah, so the correct answer is becoming an authorized user on an adult card, but the other ones, such as making the minimum payment or not using your credit card at all, or even maxing out your credit limit, will all decrease your credit score. So not using your credit card will not help you build your credit score because there's no information that financial institutions and lenders can work with. If you make the minimum payment each month, you're going to have a very high credit utilization ratio, as well as also if you max out your credit limit, it means that you've used a very large portion of the amount that you're able to borrow, and you've only paid back a very small amount, and these will all contribute to decreasing your credit score. Yeah, so this question actually has two answers. Assets are essentially what you own and your liabilities are what you owe. And so when you subtract that, you will be able to find your net worth. Whereas the other two answers, it is put in reverse, which is why those two are incorrect. Yeah, so this is true. Having a bankruptcy will appear on your credit report, which can look very bad to lenders and financial institutions when they take a look at your credit score as well as your credit report. Yeah, so the correct answer is that you can get a copy of your credit report for free. The other ones are incorrect because number one, there are only two main credit bureaus and you can get a credit report at any age. It does not have to be when you're 21. You can get it as long as you have working credit and a credit card. And it is not just a complete history of only one type of credit, it's multiple. So we have different types like revolving, installment, and open, and all of these are factored into both your credit score and by association, your credit report. Yeah, so what bank you get your credit card from, or whether you get it from a credit union, this has absolutely no impact on your credit score. Yeah, so this one also has two answers. Getting a higher interest rate on your credit cards and loans is not actually a benefit. That is a downside when you have a very low credit score. And so when you have a good credit score, you qualify for lower interest rates, and you can also get, and it has absolutely no impact on your retirement fund, which is why that answer is also incorrect. Yeah, so that is the correct answer. You should not wait until the end of the month, and finding errors is not something that is common. So if you do find it, you do have to address it, and you will not have to pay a fine. You will just have to file a dispute, as it says on the screen. Yeah, so spreading your money among all of your credit cards will actually help you decrease your credit utilization rate, which will increase your credit score because you are using a smaller amount of the money that is available for each credit card. And making several payments is also good because it shows that you're paying off your balance regularly as opposed to waiting until the last minute to pay everything off. Whereas keeping your credit utilization to 55% is actually a very high number, and that will decrease your credit score. And using only one credit card will also decrease your score because you're not evenly spreading it out among a lot of different types of credit, which is 10% of your credit score. And so this is two different things that can contribute to having a thin file, which is basically a very brief credit history. But having 4 credit cards open is actually going to have make you have a longer credit history, which is why that answer is incorrect. And having multiple lines of credit open will also contribute to increasing your credit score. So those are the 2 answers that are incorrect to this question. Yeah, so a credit score is determined by the factors that are covered in your credit report. So they are related to each other. And whenever you see your credit report, you will be able to also see your credit score on that report, which you can access for free once a year. Yeah, so the correct website is annualcreditreport.com. Make sure that you are not using any website that may be saying that they will be able to give your credit report, but is actually a scam, so that you don't give your information away online. But that is a website that you can go to that is accredited and trustworthy. Yeah, so minimum payments on large loans and paying extra on small loans. Essentially, what you do with the debt snowball method is you start off by paying something that you owe the least to, and then as you do that, you gradually move on to bigger debt that you may have. Yes, exactly. So I see that most people got that correct. Basically, having a thin file means that you have almost no credit history or maybe none at all. And this will mean that you may not be able to, or you most likely are not able to apply for and receive loans. Exactly. So with the high rate method, you essentially have to do the math and understand which loan that you have will cost you the most amount of money over the long term. And then you begin by paying that off. And then you progress on to smaller loans in that order. Exactly. So with federal student loans, you will not be able to erase or reduce this type of loan, but the other ones that you are able to do that. So, and basically for the federal ones, that is not possible. Exactly. So that is the one thing that they can do. They cannot arrest you for it. They also can't contact you at work. And they, of course, cannot reach out to your friends, but they can call you anywhere between the day to talk to you about it. Yeah, so this is the only thing that you can find on your credit report of all these different options. Credit reports do not factor in your education level, your family's contact information, and they also don't factor in your medical insurance information. But the different types of credit that you have and the hard and soft inquiries that you make are an important part of your credit score. And so this is something that appears on your credit report. Exactly. So as we discussed earlier today, landlords, future employers, and insurance companies can ask for your credit report and credit score to make decisions about whether they want to hire you or they want to lend you money. However, colleges and universities do not look at this information. So these are two ways that you can increase your credit score, and I see most people chose the yellow one. So paying your payments off on time is a great way to increase your credit score because this increases your payment history. Diversifying your credit is also important because the different types of credit that you have, they contribute to your credit score as well. Whereas increasing your credit utilization actually decreases your credit score, and getting more credit cards also decreases your credit score because every time you apply for a new credit card, you're increasing the number of hard inquiries that you make, and each hard inquiry decreases your credit score by about 2 to 3 points. And so in the short term, that would decrease his credit score if he were to open a lot of different credit cards at once. So congratulations to our top 3 winners, and also thank you to everyone for participating. So again, congratulations everyone. And now we are going to be moving on to the last part of the event, which are the feedback forms. I will type that in the chat, and also we'll play some music, and you guys can fill that out. Make sure to do that because that is how we will be able to hand out certificates, and also how we can know what to change or improve for the next 2 days of our event.